We are officially live on YouTube for the Thursday edition of the Not Your Average Investor Show, the JWB Property. I am your host, Pablo Gonzalez, and with me, as always, is the man that I affectionately like to call GC, because he's got the genius concepts, because he knows how to generate cash flows, because he's a great co-host, and because at birth he was named Gregg Cohen. Say hello, Gregg.
Fact. Hello, everybody. Great to be with you.
And our community manager, always helping out in the chat, making it easy for you to connect with us and each other. We call her MTM because she provides the moments that matter, and because her name is Madison the Magnificent. Say hello, Madison.
Hello, everybody.
All right. And, if you're joining us, we have this like growing live YouTube audience. Love having y'all watching. We love the podcast down. I haven't told you, but the podcast downloads have been going up lately.
We need to ask you about that.
Yeah. I don't know the exact number, but we're somewhere out around like 600, 700 downloads a week lately, which is pretty sweet.
It's awesome, man.
So if you're listening on the podcast, we'd love to have you join us live here one of these days. Go to nyais.com, join us live, be part of the community. If you're part of the community, tell your friends about it on the podcast. It's a lower ask. Share it with them. Not Your Average Investor Show on any of the platforms. But for those of you that are here, we do it specifically for you because we like to cheer you on in the what?
The roll call, baby.
The roll call. We got Madison in the roll call saying, welcome to the Not Your Average Investor Show. We got our leadoff hitter, John Henning, saying good afternoon. We got the ringmaster of the Not Your Average Investor Show community batting second, Drew Barnhill, saying good afternoon all. We got the MVP of the Not Your Average Investor Show community, Lee Bishop, saying good afternoon, everyone. Happy birthday, Pablo.
What else is he saying? He's saying happy birthday.
He said happy birthday. It was my birthday yesterday. We had actually my team put together this like compilation of all my friends, and we had I think like four or five actually of the Not Your Average Investor Show community.
Absolutely.
Marilyn, Lee, Drew, Hervé, 5. Jen killed it singing. So did Hervé, by the way.
Her voice, crazy.
Yeah, it was amazing. It was amazing. So thank you all. Thank you so much. I really, this community means the world to me. We got into the lights. Aaron O'Neill checking in early. Good to have you, Aaron. We've got Leo Baraganan.
Dun, 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 dun.
Baraganan.
Dun, 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 dun.
Checking in, saying good morning all from Bay Area, California. Let's rock. We got our regular Rosalind Riley saying good morning, everyone from Murrieta, California. We got Donna Chica is back in the house. Welcome back, Donna. We got Lewis Hudnell with my favorite place to mispronounce, morning making money moves from Minipitas, California.
Well done. Alliteration on that one.
He did that as well done. We got the man that everyone knows.
Noah Rundari.
Noah Rundari, greetings from California. A lot of West Coast representation in the house, including the first family of the Not Your Average Investor Show community, the patriarch Ken Moline, the matriarch Carolyn Moline. We salute you. We got someone else checking in as Not Your Average Guest. So funny thing, we got these text reminders coming in that we put this link in there, make it easy for you to join. If you join through a text reminder, your name defaults to Not Your Average Guest, but you can change it in the chat if you like. I knew that Leo was one of them just because of his trademark rock on.
Let's rock.
Let's rock. Yeah. But we got somebody else saying good morning all as Not Your Average Guest. Good morning. No, anyways, welcome back to the show. We got our boy, Sergio Prieto. Go Gators.
Go Gators.
Sergio, good to have you in the house. Thank you for the birthday wishes here in the chat that are happening. Denny Davies from overseas saying Guten Tag, Denny. We got Bob Wiesner in the house. He's back. Wishing me happy birthday, Bob. Good to have you back, man. Love to see you here in the community. We got Tony D in the house, Anthony Ditta from South Florida, and we got Marilyn Connerman from Homosassa, Florida.
Home of the manatees.
The home of the manatees, where you can swim with manatees in crystal blue waters.
Marilyn had quite an appearance on your video too.
Marilyn had quite the appearance on the video. Marilyn, former Miami Dolphins cheerleader.
That's true.
Making a cameo on I feel pretty special.
You should.
I feel pretty special. But speaking of feeling special, I want to go to the most special segment of the week.
Mm-hmm.
My favorite segment of the week.
Mm-hmm.
When Madison shares good news.
Hi, everybody. So good news this week is I just really want to give a shout out to our property management team. I have the honor of sitting in the same vicinity as them. So I get to hear them talk to residents, talk to each other, work through all these cool different problems. And I want to shout them out because they have surpassed over 900 renewals so far this year. So, and why that's important to you guys is because the more they renew, the more you save. On average, when they renew leases, it saves you as the investor between $5,000 to $7,000 because you then don't have to go through a property turn. So super cool. Really happy to be on the same team as them. And I love to watch them shine. So
How many lease renewals this year so far?
over 900.
Over 900 lease renewals. Somebody do the math here. 900 times $6,000 of expenses.
What do you have to carry on that one?
I don't know. There's a niner in there somewhere.
There's a niner in there somewhere.
There you go. When we talk about a vertically integrated team, we're talking about this beautiful combination of everybody being under one roof and having goals aligned. This is a great example of that. When we renew your lease, we are so fired up because it saves you, as Madison mentioned, between $5,000 to $7,000 every single time we do that. So super, super proud of our team. Well done, Madison. That's great news.
Saves $5,000 to $7,000. Also generally increasing the rent as well, improving cash flows on a month-to-month basis. I recently went through one of these, like, are they going to renew? Are they not? When we got the good news that they were going to renew, you know what I said to my wife?
What'd you say?
I said, that's good news. Thanks, Madison. That was awesome. All right, GC. Well, I guess we got nothing else to, but breaking news, GC. What do we got going on after this good news that we heard? What do you got for us?
You know, I bring a little bit of the overall economy, the economic news to you. And guess what? It ain't good.
It's not. Madison's not reporting on this one.
It ain't good news. It should not surprise anybody, though. We continue to talk about this because it's important. And, you know, the role of this show is to be transparent, relate what's going on in the overall economy to rental property investing. And if we can give you a little bit of insight as to what's to come, man, that can really help you. And so that's what we're doing here. The breaking news today is that the Fed, as expected, raised interest rates another 3/4 of a point. The thing that everybody needs to understand is that when the Fed raises interest rates, normally they raise interest rates not 3/4 of a point. Normally they raise it about 1/4 point. That's pretty standard. So just to have one raise of interest rates that is 3/4 of a point is 3 times the normal raise of interest rates.
Mm-hmm.
Okay. Prior to the first time that they had raised interest rates 3/4 of a point, the Fed had not raised interest rates this much in 28 years. They hadn't done a 3/4 point hike or more in 28 years prior to the first time they've done this.
Mm-hmm.
The last, and I don't know the exact number. Somebody help me out in the chat. It's either the last 3 or the last 4 or 5 raises of interest rates. Guess what they've all been, Pablo?
3/4 of a point.
3/4 of a point. The Fed has raised the short-term borrowing rate for banks, which is what the Fed controls. The Fed has raised that from about 1/4 point, 0 to 1/4 point to almost 4% in the span of, give it about 6 months. That type of raising of rates is almost unprecedented. It hadn't happened to that degree in 40 years in our economy. So you got to be asking yourself, why is the Fed going to such extreme measures? And hopefully veterans of this show understand that it's all about inflation. Inflation is here. It is not going away as fast as we want. And the Fed's opportunity to change that is their thinking is like, listen, if I can increase the borrowing costs of everyday Americans, and if I can increase the borrowing costs for companies, ultimately what will happen is that will drop consumer spending. Dropping consumer spending is what we need to happen for inflation to come down. When you drop consumer spending, one of the things that happens when you drop consumer spending is typically there are job losses. And so if anybody's reading up on what the Fed is saying, they are saying inflation is high. It's here. We cannot get it down fast enough. We're willing to do whatever it takes to get inflation down because we understand how terrible that is for the overall country. Even if that means we have to raise interest rates so much that there is pain in this economy, that there are job losses that are coming, we are willing to do that because it is better than the alternative of continued inflation here. So it's not good news.
That's wild, man.
It's not good news.
Yeah.
It's not good news. We tend to now just think, oh, the Fed just raised the rates again. They didn't just raise the rates. They raised it 3/4 of a point, which is monumental in itself.
Yeah. Yeah. Drew's putting in the chat. They've raised it 3/4 of the points 4 times. And before that was a 0.25, a quarter raise and a 1/2 point raise. And now it's 4 more times at 3/4 of a point.
Yes.
Which, you know, I remember you early this year talking about, hey, they just, or maybe it was like November last year. You were just like, they just killed quantitative easing.
Right.
What's coming next is interest rates, and they're going to raise interest multiple times this year. And, I mean, I guess I'm not going to put words in your mouth. Did you expect it to be this much?
No, I expected it to be fast and furious, which is what we talked about. But this is unbelievably high in a short amount of time. And I don't think anybody out there expected it to be this drastic. And the problem is because inflation is this big of a problem. That's the reason that this is happening. So, what you all should be taking from this. Oh, and here's the future projections is that we're going to see more increases.
Yeah.
The Fed has already said there are going to be more increases. Yeah. So this is not the last of it.
What I've read, or what I've heard more accurately, is the idea that, like you said, what they're trying to do is curb consumer spending. But right now, people aren't spending borrowed money. The economy has a bunch of people saved a lot of money during COVID because you weren't eating out, you weren't traveling, all this other stuff. So people are still spending pent up savings, pent up cash reserves. So they haven't even dipped into like the debt that they normally spend that gets the economy going. So they're going to keep doing this until people run out of money from their savings. And I think that raises this like double-edged sword of like, well, okay, you have this pent up spending. Should you go out and spend it before stuff goes up? Or should you keep it under a mattress while inflation is raging? Or do you put it in the stock market that is tanking? What do you say about that?
Well, I think knowing what we know right now and knowing the major problem of inflation that is not going away easily, and knowing that the Fed is already signaling that you're going to be raising rates going forward, you should be asking yourself, with the places that you currently have your money there, how are those places poised to perform in a recession? How are those places poised to perform when consumer spending cuts and there are job losses? Which assets are you in that are better positioned to perform in the short run and the long run there? And history will show you that the stock market does not do well in recessions, right? Bonds right now are not doing well or not expected to do well because bonds, the return on a bond is lower than inflation. So that's like you saying you're going into that investment expecting to lose a certain percentage of money, right? We don't like investments where we're going and expecting to lose, right? So you're not beating inflation there. And then as the Fed continues to raise rates up, that pushes bond rates up, which has an inverse relationship with prices. So bond prices are expected to go down. That's what the Fed is saying when they say Fed rates are expected to go up. So bonds are not looking good in the short run or the long run, right? You should be looking for an asset class that is positioned to perform well. And most of you know that is rental properties, right? Most of you know that in the short run, rents are expected to go up in Jacksonville, right? That rents historically don't go down even in tough times. Rents are expected to go up in Jacksonville. Actually, the number is 3.5% according to John Burns Real Estate Consulting. That's just fresh off the press. So rents are expected to go up. Short run, rental properties are looking to be consistent and strong. Long run, we know how market cycles work. And home price appreciation, we've been through this. We've been through the Great Recession before, and we see that over 10 to 20-year cycles, your home price appreciation on average comes back to the norm. So regardless of whatever happens for pricing, short run and long run look good for rental properties. And I don't see other asset classes that look good. And I want everybody to know that this recession that is probably coming is the indicators that we see now would lead people to believe that it is going to be a big recession and that the effect on the stock market would be substantial if you're just comparing the indicators that we have right now compared to historical indicators and what the stock market did. So be thinking about this now. We haven't felt the full pain in our economy. We are going to, and you have the opportunity right now to put it in an asset that is more consistent.
As I'm thinking as this as an investor, right? If I was somebody, I listened to you when you were talking about all this happening and I pulled forward my demand and I've gone all in on rental properties and it's gone well. But if I'm somebody that's still kind of like sitting on the sidelines or looking at this right now, I guess I'm thinking this stuff's, like interest rates are going to continue to go up. If I can't pull the money together before the next rate increase, at what point does it stop making sense? Even looking at this, right? Like even looking at, I guess there is there's cash buyers, right? Like if you have enough to buy a home in cash right now, that is, to me, it's a no-brainer, right? Like buying a rental home in cash right now, no brainer. When rates go down later, you can like refinance it, or I guess you don't finance it. You just pull out.
Yeah, you could refinance it later on.
Even if you you cash buy. So, but right now, maybe you're pushing into this idea that like cash flow is super compressed with the higher, with the finance stuff. Why does it still make sense, man? Like, why would it still make sense to buy something financed right now with little cash flow, knowing that you're going into this uncertainty? Like, what is I don't know. I'm trying to think. If I have like $80,000, right, which is probably what it takes to get you into to pick up a rental property these days, what are my other options? Like, what else could I do with that wouldn't be this asset class? And then how do I think about it in the medium term?
Okay. So you want me to go into other opportunities and outside of rental property investing right now?
Yeah, I guess.
Okay.
Yeah.
All right. Well, cool. Let me come back a little bit there.
Okay.
Or
should we just go to the house and then we talk about that? I mean,
well, let's talk about the house there, but let me just tell you about some other options, because it's not only rental property investing, right? Yeah. I think let's unpack that a little bit, specifically in the rental property realm when we're talking about property.
Kelly's question is what I'm asking. Why now instead of 6 months from now?
Gotcha.
Right? Like that. I think that's the real question. So Kelly Barenbaum, welcome back to the show, Kelly. Good to have you back.
Kelly, fantastic.
Yeah.
To have you.
Kelly writes, why invest in real estate now versus 6 months from now when real estate values maybe lower, or maybe interest rates are lower, right? Like maybe when the bottom drops out or something like that. Like,
well, you know what? We don't know what prices are going to do 6 months from now.
Yeah.
So we don't know that home prices are going to be lower. We don't know that home prices are going to be higher. We don't know that home prices are going to be flat. So we don't know that, right? But in the short run, we can look at what do we know? And even if we're not talking about home prices, we're talking about 4 other profit centers that do work for you, right? So net rental income, positive cash flow. That's still here. We're talking about how it's gone down from the past, which is true. But if we're still looking right here, which is your job as an investor, is to make the best decision with the information that you have right now, you're getting positive cash flow on rental properties here in Jacksonville. And, comparing it to the other alternatives, stocks, you're not getting cash flow, right? Bonds, it's not showing up monthly and it's less than inflation, but you are, but that's all you're getting in bonds. Rental properties, you still get tax savings. That happens at each and every year, right? Principal pay down still happens. Inflation hedging still happens, right? So even if you are concerned about home prices in the short run, you still have 4 other profit centers that are really working well for you, right? So comparing that to your other alternatives, if your alternative is just to keep it in your bank and keep it in under your mattress, you're going to lose 8% on your money, according to what inflation is right now. Inflation is probably going to be coming down slowly. Okay. Right. If you're going to do that, you're just saying, hey, listen, I'm going to lose 8%. Right. So, we just talked about 4 of those 5 profit centers working for you immediately. Well, that's better than losing 8%. If you're putting in the bond market, and let's say you're earning 4% on your bond, right? And inflation's 8%, that means you're losing 4% a year right off the bat with inflation the way it is, right? So you're going in this losing 4% versus rental property investing. Again, don't even pay attention to what prices are going to do, right? Versus those 4 profit centers, which is better than losing 4%. And then if you can put in the stock market, I'm really, really concerned that you're going to lose capital. Yeah. So if we just take the home prices discussion out of the equation, and you just look at those 4 other profit centers compared to everything else, you're going to perform better than the other alternatives. We don't know exactly what prices are going to do. Kelly, I really want you to be here on our client-only call on December 5th. Kelly, I don't know if you're a client. First of all, I should probably ask if you're a client. I hope you're a client. And if you are, I hope you join our client-only call. If you're not, we're going to do a recap of that.
We'll recap it on Tuesday
for the group after. But I'm spending a lot of time with my team and with experts and consultants, putting our ideas together for what next year is going to look like. And I know you're all concerned about home prices and rents. And I'm going to be able to share with you what our thoughts are on that. But I will tell you, no matter what I say, short-term pricing is the least most important part of this equation. If you are buying and holding for a full market cycle, doesn't matter what home prices are going to do next year.
When I think about Kelly's question, like word for word, right? Like, why not now versus 6 months from now? I feel like if Kelly is really talking about right now, right? Like I think in 3 months, this may be different, but if I'm thinking right now, then just the idea that if you do it right now, you're going to lock in the entire year's worth of tax savings before end of year.
True. Good call.
You know, like if it's a matter of like this week kind of thing, or in 2 weeks or whatever, right? Like you lock in that. So that by itself becomes a faster, you know, cash in hand profit center for somebody if you were to do that right now.
Right.
And then on top of that, I think right now, it's pretty clear that the same thing that is pushing home prices up still right now is the same thing that's driving interest rates, is that people still have cash on hand. People still have this stuff. They're still spending. So in the next 6 months, it's a matter of like, how long are you going to wait to invest money? Like if you're sitting on cash that you can invest, whether it's, let's call it liquid cash. So stock market, which you can liquidate, or money under the mattress, you know, how long do you plan to wait with that? Right. Like I made that mistake in like 2014, right? Like I made that same mistake when I cashed out my private lending with JWB back in like 2014, when I had no idea what the heck I was doing. And I didn't even know.
I thought we'd be right here right now.
Yeah. I didn't even know you. I knew Alex from Flip Cup, bro.
We weren't even friends.
Yeah.
Definitely.
I knew your business partner from tailgate drinking games.
Nice.
And I sat in the sidelines with that, and I lost out on that amount of time. Like I'm pretty sure that if I would have put that money to work at that point, then I would have 5 or 6 rental properties, you know? So I do think about that idea, and the fact that in the next 6 months, it's pretty clear that interest rates are going to continue to go up until a recession hits and all this stuff happens. And then at that point, once that happens, what's the decision-making criteria? Well, now that things are going down, now I'm going to wait for prices to actually drop too. Like, are you going to sit in the sideline for a year while you lose money in the stock market and or your spending power goes down with that capital, right? Like if I think through it that way, I don't know. I'm just thinking out loud here.
Yeah. Let me just wrap it up.
Yeah.
Like it's the concept. If you believe that time in the market is more important than timing the market, then it makes sense for you to invest when you have, even if there's one profit center you're not sure about, right? That 4 of those profit centers could work for you immediately day one. That's a pretty good reason to do that. If you are somebody who thinks that you can read the market, whatever market it is, real estate, you know, stock market, whatever, and you know exactly when the bottom is, then you would say, hey, listen, I have more value based on my knowledge and experience to be able to time this thing. I know exactly what's going to happen in 6 months. Therefore, it makes better. But I haven't met one of those people that feels confident.
Yeah, that's true.
So, and as we mentioned, right, this is built on buying and holding. Yeah. I have lived buying 40 rental properties at the height of the bubble in 2006 and 2007.
That's right.
And I still own those rental properties. I didn't have to give one of them back to the bank. And it was because short-term pricing didn't matter to me, because my outlook was buying and holding for the long haul. And I had positive cash flow, and I had tax savings, and I had principal pay down, and I had inflation hedging working in my favor. So that was a beautiful combination. And that's why, you know, that was my foundation for how I got into rental property investing. I'm not saying that's what we're going into in 2023, but if I'm trying to speak to all those who are saying, what if home prices would fall, right? Well, just know that if your horizon is a long-term outlook in this asset class, then you don't need home prices to go up next year. It's actually not even going to change your life at all if it happens next year. Just like if home prices would fall next year, not going to change your life at all, because you're banking on those 4 other profit centers.
Cool. And I asked, we did this episode where, because I think Kelly's pretty new, right? Like we did an episode where we did the case study of Gregg's homes in like 2006 and how they've performed versus Warren Buffett in the market. So you might want to check that one out. I think Madison's going to work on getting that to you. David Blattner also puts, so there's still such a shortage of these entry-level single-family residence houses that I think prices will not decline much, probably will continue to increase at a low rate at the very least. And he also says luxury houses and apartment complex, that may fall some. I kind of agree with that.
Yeah, I think David brings up some really good points. He talked about the shortage of inventory, which would help to stabilize prices, which would raise the floor of what prices would do. And he also talked about which segments of housing are more risk mitigated.
That's right.
Which is why we focus on affordable housing, on workforce housing, right? Because your risks are mitigated there. And that's going to be proven, has been proven out. And you're even going to see that more as 2023 unfolds.
All right, man, let's get to the property. I thought that was a great discussion. Kelly, thanks for posing the question.
Super appreciate you, Kelly. Super appreciate all the new folks who are jumping in, all the not your average guests. We appreciate it. You guys being here.
Definitely. Well, GC, before we go into that, gold and silver, man, I see. Oh, here we go. We got Drew in the chat, who is super smart. He's putting some stuff along the lines of, if you're looking for long-term investment, gold is not a good bet. You can choose any 20-year period over the last 100 and gold underperforms. You have to be a trader to make real money in gold. How much do you know about that stuff? About like he's essentially saying you got to be an active investor, not a passive investor.
Yeah.
In order to outperform with gold, and whether or not gold is still a good storage of value.
So personally, I don't invest in gold. I've never actually bought gold. So, but I know enough about gold. I mean, people go to gold in recessionary times. So that's why people are asking the question. It's like, oh, well, if the economy sucks, should I go to gold? Because that's, it's a store of value is what people think. It's a defensive move. It's like, how can I preserve my capital? So, in theory, in recessionary times, that would be a place to go to. But, this is the trifecta you need to look for right now. How do I beat inflation?
Mm-hmm.
How do I mitigate risk?
Mm-hmm.
And how do I do that passively?
Yep.
Right. Gold doesn't meet that standard, in my opinion.
Okay. All right. Cool. Then let's get to it, GC. Let's magically whisk ourselves away here. Man, we took a long conversation here.
It's awesome.
I love it, man. This is so good. All the new folks and the added interaction of.
Can I just share that for a long time? I thought I was just a weirdo, that I love to have conversations like this, talking about the economy, talking about rental properties, talking about whether good things are happening or if recessions are happening. But the fact that we have 35 folks that are here, and that every week we have 30, 40, 50, 60 folks that come here each and every week, and they know we're going to talk about this stuff, and they keep showing up, I feel less like a weirdo now. I really appreciate you all. Maybe we're all weirdos. I don't know.
I mean, I used to not enjoy this, and now I do. So I've become a weirdo, and I like it, man. That's why we're not average. So
there we go.
Yeah.
Better way of saying it.
Yeah, not average. So now we're magically whisking ourselves away here to 2404 Glen Gardner Drive, Jacksonville, Florida, 32246. If you want to download this property eval, go to jwbinventory.com. But I think Madison's going to put it here in the chat if you want to just download it if you're here present. We got this beautiful looking home that is a 4-bedroom, 2-bathroom, 1,648 square foot home at a purchase price of $350,000. That one's up there.
That's some cheese, huh? Last week it was $185,000. This time I'm like, no, I'm bringing the realness here.
You flipped it on us. You flipped it on us. Monthly rent of $2,250. Construction status is 30 to 45 days out. Leasing term, a 2 to 3 year lease. Annual appreciation rate on a 20-year average of 4.6%. And what we all are actually really investing here as not your average investors in rental properties, this 11.4% internal rate of return, IRR. GC, what do you love about this property?
I thought you'd never ask. Well, I'll tell you what I love about this property. It's those 3 things that we talked about. This should be the criteria of where you are putting your money right now and where you want to put your money, especially going into next year in recessionary times. Can you beat inflation? Can you mitigate risk? And can it be passive? When we look here and we see an estimated return on investment, an IRR calculation of 11.4%, number one, we're beating inflation. What's inflation right now?
Too much. 8 point something.
8.2%. We're beating inflation. Okay. Number 2, we're mitigating risk. We're investing in single family rental properties, which over decades and decades and decades have proven to be a consistent asset class, much more consistent than other asset classes like the stock market. And we have even in the last couple of years witnessed super out of the ordinary events like a pandemic, right? And like interest rates rising like they have over the last 6 months. And guess what? Real estate's still performing. Rental properties are still performing. Yeah. Rents are even still going up.
Yeah.
Right. So consistency in the face of other asset classes being extremely volatile is risk mitigation. And there's other levels of risk mitigation. When we talk about David Blattner's comment earlier about how we focus on workforce housing, that's another way to mitigate your risk. So risk mitigation, check here. And third is passive, right? This is built for busy professionals who want to invest in real estate, but don't have the time or the experience or don't live in that market. And so you have the opportunity to be passive in this if you choose the right team. If you choose a vertically integrated team where your goals are aligned, this can be passive for you. So number one, that's what I love about this property. But, I'm always prepared a little bit more.
I know.
I know.
Go deeper. Go deeper, GC.
We hadn't talked about our neighborhoods that we invest in quite a while.
I've had a feeling you'd bring up neighborhoods.
This is in one of our 4 core neighborhoods. These are the same 4 neighborhoods we've been investing in since 2006. I own properties in the South Side, which is where this neighborhood is in Jacksonville. We love those neighborhoods. We absolutely dominate those neighborhoods. I don't know if you have the map at the ready here, but if you do or you don't, if you're a client or you're about to be a client, when we're onboarding you, we show you a map of all the rental homes that our clients own with us. And so it's largely in these 4 parts of Jacksonville, and that's by design. Right. So this home is in the South Side neighborhood, as I mentioned, 32246. I was just going to tell you a couple of things that are job creators about South Side. Now, this isn't to say that I love South Side more than the West Side or Arlington or the North Side. I love all 4 of them the same. All of them have job creators, but I just want to tell you about a couple of them. So in the South Side, we have this wonderful outdoor lifestyles mall called St. John's Town Center. St. John's Town Center is a pretty big deal, huh?
Pretty big deal.
Yeah.
Pretty big deal. Yeah.
I did some of the data or the research behind it. So over 150 stores, dozens of restaurants. There's a Topgolf there. There's dog parks. There's IKEA. It draws about 10 million visitors a year at this St. John's Town Center. 35% of the visitors drive at least an hour and a half to get there. In today's day and age, to get people off the couch and get them to drive anywhere is pretty tough.
Hour and a half, 35%. I got to drive 20 minutes to go there. And I'm like, God, but it's worth it.
Exactly.
That's insane.
Here's another stat. So restaurants there are doing about $1,000 a square foot in revenue, which places them in the top 3% of the nation.
Mm-hmm.
So this is an attraction, right? Mm-hmm. And this is an incredible job creator for you. Your home here on Glen Gardner is like 5-minute drive.
Yep. And I got the map. You asked for the map. I got the map for you, buddy.
Look at you.
This is the data set of the thing that drives the flywheel. Look at that. It looks like a flywheel. All the data points here in Jacksonville, all the homes that you manage in your core neighborhoods.
Mm-hmm.
This is that South Side neighborhood here, right?
Yep.
And that spot in green, I know, GC, that's not your specialty, but this right over here is green and these other ones are blue. St. John's Town Center is like right around here, right?
A little bit south. Right, JTB.
Is this JTB here? Oh, okay.
Yeah. So a little bit farther south than that.
I think this is St. John's right here. This little shopping bag.
Yeah.
Anyways, right around here.
All right. I don't know. It's right down there on Costco, right? The next one down. That's Atlantic.
Is it Atlantic?
Oh, no.
This is riveting television and even better podcast.
There you go.
but anyways,
right. You or me.
It's right here. Yeah. Oh, yeah. That is Atlantic. You're right. Yeah, it is right around here.
There you go.
Topgolf. Yeah, there you go. So you are just right shot down to this big entertainment district in the middle of all these other JWB homes, what you're talking about. Anyways, continue.
Well, so it's not the only job creator there. We have the University of North Florida. So
that's right.
17,000 students at the University of North Florida. And guess what? Most of them live off campus. Great residence for you, right? The name of the game. The reason why we're talking so much about these neighborhoods is because we want great residents to be able to rent your home here. And that's what we have. It's a top 10% of universities worldwide, and it's been voted a best in the Southeast College by Princeton Review for 12 years and maybe even more. This data was from a year ago when I read the article. So 12 years at least. So you've got these incredible job creators that bring ideal residents to you. And it's one of the reasons why this asset will be consistent. It will beat inflation, will be passive for you.
Love that, GC. So yeah, man, we hadn't talked about that South Side neighborhood in a while. I'm going to bring the property back up here.
Yep.
And $350,000. So this brings up David Blattner, brings up this a good point. He's the one that brought up the whole idea of risk mitigation.
Mm-hmm.
Is this still a risk mitigated asset here at the $350,000 price point? Is this the way that he asked it is this class C because it looks nice and expensive?
Yeah. Class C, class B, the reality is that a lot of that is subjective. Mm-hmm. And so, yes, this is the South Side neighborhood is more middle income. We want to invest in below middle income to middle income type housing. That's what we call as workforce housing, right? Mm-hmm. And so this is in the South Side, which is, it may be B class to some of you, it may be C class to some of you. It's highly subjective. I think the real question is this risk mitigated? Absolutely. The best way to see if it's risk mitigated is it cash flow positive, right?
Yep.
Is it cash flow positive? Yeah. And then the other question, let's just talk about price.
Yeah,
right?
let's talk about price.
The last week, a property of the week was $185,000.
Mm-hmm.
You know, $350,000 is a significant increase. So let's just talk about this, right? You know, and I say this even when we put $185,000 properties up there, which we did last week, which is the lowest that we've seen in quite a while. So that's unusual. But when we're going through that, Pablo, I'm like, listen, I know you guys are looking at the purchase price, but I want you to focus on the return on investment. I want you to focus on the IRR, right? That's the same message that I want to share with you right now when you see a $350,000 property. Like, your job as an investor is to use whatever amount of capital you have to give you the best risk-adjusted return. So if you're somebody who has $350,000 in the stock market and you're looking at this and you're saying, I'm really concerned about how the stock market is going to perform going next year into a recession, and you're like, I think I'm going to lose money in the stock market. Like, you can look at this and say, well, maybe I buy this cash. Maybe I use conventional financing, but this price might be a much better use of your capital to get you the best risk-adjusted return, right? We got to look beyond just the purchase price. And I'm talking to folks that have the budget to do it, right? So don't just look at the purchase price and say, this is a less good deal because it's expensive. And don't just look at the purchase price when I bring a property that might be $225,000 to you and say, that's a better deal because of the purchase price, because that's not how you make the best risk-adjusted return decisions. Something else to keep in mind. And I know that's a highly unpopular thing to say, by the way, but that's real. And I bring that to you because that is what I've trained myself to do. Be able to make the best decision.
That's how investors think, right? Like, they just think of, like, I have this much money to put to work. Where do I put it to work? Right. Like, it's not, if you have $350,000 to put to work, here's a great option to, like, go buy cash. If you have $100,000 to put to work, maybe you're financing something like this, or maybe you're, like, going in on private lending or whatever, but it's just like finding the best place. Not so much, is this house a price? And the thing that I've learned as we've been on this journey from, like, day one, I remember even with you, man, when we first sat down at that happy hour to discuss this idea of having a show and creating a community around it and all this stuff, the message that, I think was out there in the ecosystem is that folks were buying homes. And the real message here is this idea that you're not, yes, it is a home that is what ends up under your, control or your possession, but you're buying into an asset class and you're buying into a return and risk profile. And that, I think, has been the journey that we've all really been on over the last 3 years, when it went from people calling JWB and saying, oh, let me take a look at a home and see blah, 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 to say, I have this much money. Do I buy a home? Do I buy 3 homes? Do I, what are we doing here? Because it's really just about, like, asset allocation versus a risk reward kind of, like, standard of what you're looking for, which is why you argue that this is the best asset class, because it has the highest ROI based on the lowest amount of risk for anything anywhere close to this.
Yeah, that's right. Let's take this example, and I think it's best for us to relate it to other things that people are investing in right now.
Yeah.
People are investing in the stock market. Okay. What's the highest priced stock out there that everybody wants to be in?
Berkshire Hathaway.
Berkshire Hathaway. Right? Everybody wants to invest with Warren Buffett. If only Warren Buffett could control my money, I don't care what the stock price is.
Yeah.
I want to buy that one.
Yeah.
I don't know, another, like, Peloton stock, right? I don't know what it is. It hasn't had a good year.
It's
right?
not been good. It's like $8.
Are you listening to say, listen, Peloton's cheaper?
Yeah.
I'm gonna be feeling as good to invest in Peloton
or call it Apple, right? Apple's a single stock that's a store of value, right? Yeah. Something like that.
Yeah. So it's, we need to look beyond price.
Yeah.
Right. The clients who are able to do that are more successful, right? Not just in JWB, but they're more successful in all of their investments, because at the end of the day, this is the market value for the home. It happens to be $350,000 because that's what all the other homes around it are selling for. Just like that $225,000 home that I'll bring to you, every other house around there is selling for $225,000. So, as long as the budget can afford it, that's who I'm really speaking with here. Price is one factor of return. You need to focus on return, best risk-adjusted return on investment here.
Got it. Okay. I get it, man. All right. So Jag's got a good question here. Jag is asking, question. If you are building this from scratch, right? So this is under construction rate. So it's a ground up construction. Why not put a duplex here? Wouldn't that have better rent?
You know, it's a really good question. We thought a lot about that, right? You know, we build a lot of houses and there would be an opportunity to build duplexes and triplexes and quads and all that good stuff. And we make the choice not to. And it's a multifaceted decision. You know, I have no problem with multifamily properties. I think they're wonderful. If everything else was constant and even, like, sure, I would think multifamily would be great. But in Jacksonville, they're not. So in our neighborhoods, one of the ways we win and why we're able to produce this new construction inventory at such low prices, because there's no other builder that can produce this house at that same price. Like, I don't know if people understand that, but one of the ways that we win is because we go into neighborhoods that are already developed, where another developer has gone in and spent $50,000 per house to do the horizontal, which is the streets and the curbs and the utilities, and they do this in these big developments, but there might be a house they just didn't build on. And that's the type of lot that we buy. We are not like typical builders where we build 100-unit subdivisions. We go and we find the lots that have a lot of hair on them that nobody else wanted. And we go and we buy those lots. And what we do is we buy those for less than another builder could build on them for. And when we do that, we have certain restrictions, right? They are in established neighborhoods. And so from a variance perspective, so from like the city's perspective, they're just not going to let you just build a bunch of duplexes in between an established neighborhood of single family houses. Yeah. So we're really limited on what we could do as far as getting this approved by the city in the vast majority of the places that we build. But that's not the only reason. On the back end, we think about your client experience. Financing is much more challenging for multifamily properties. And this goes to your client experience. It also goes to your return on investment. It is really, really difficult to have financing. In theory, it should be the same as single family, but it's not, because there's so few comparable sales of multifamily properties around here. So it makes your appraiser's job very difficult. And ultimately what happens there is that typically you as the borrower, you might apply for the property and to purchase the multifamily property, but the appraisal might not come in at the value that you want, which forces you to bring significantly more cash to closing. And that's a real thing. So because of both of those things, there's not enough value for us to go out and take the risk to do those things. There's not enough value for the client at the end of the day, and not enough value for us to do it. And that's the real reason why you don't see more multifamily properties with JWB.
When you say all that, I hear keeping the housing stock similar to the rest of the neighborhood is risk mitigation for everybody all the way around. It allows you to make sure that you can bring it to market on a suitable timeline, and it allows the investor to like feel safe about, you know, from the time that they close to, is it going to be ready, to getting the loan right and doing everything proper.
Yeah. At the core of this, what we set out to do a long time ago was not to produce the best returns in real estate. That's not our mission. We believe that we had an opportunity to create the best experience when it comes to investing in rental properties and perform at above average risk-adjusted returns on investment. So it's experience for us is at the paramount. I think that's why you guys choose to invest with us, because the experience elsewhere is lacking. So this also goes into that experience like you're talking about to make sure we can deliver it as promised.
Cool. A couple significant things happening in the chat. One, Madison shared the episode where we compare turnkey rental properties to Warren Buffett's track record, right? If we're talking about that, Kelly, I think, we were telling you about that. That's that case study of rental properties that you bought in 2006, right before, 6 months before it all crashed.
Yeah, that's true.
And then Bob Wiesner immediately after says, Berkshire Hathaway A stock currently at $431,700 per share. He would rather have the house, right? So like, if we're going to compare it apples to apples, you'd have to have that kind of cash to buy one share. This is one share, but this share comes with cash flow, appreciation, tax savings, debt pay down, the fact that you're going to be able to borrow against it sometime soon.
So critical.
All those things. That's really interesting. We should start tracking that, man.
You should.
right?
You
Like
really should.
the price of that share versus like the average price of a Jacksonville home, and some kind of data
Let's do it.
thing
We'll figure
that
it
I
out.
know you're capable of. All right, Jack Chatta, another great question here in the Q&A. John Burns is talking about prices dropping in single family homes. Any thoughts?
Yeah, I've been listening to John. My business partners and I listen to him every single month when he does his webinar. Jack, it's awesome to hear that you are as well. You know, he is one source that we really, really lean into and we really, really respect. I'm leaning into his data. Now, what he's talking about as far as home prices dropping is across the country. And so my job is to take his information and apply it to the Jacksonville market and see where that shakes out. And so that's what I'm going to be doing. And, you know, Monday, December 5th is our client only call. Jag, would love to have you there. We're going to put a lot of our heart and soul into it. And, you know, my commitment to you is that I'm going to be honest and transparent with where I see the market going. Haven't finalized my thoughts on that yet, but, you know, I know it's important for all of you. And so I hope you all are there. I think it's going to be, it might be the most important client only call we've had in a long time.
You did tell me that about an hour and 15 minutes ago.
I think it's going to be really important. I think so.
Has there been a new John Burns call that I haven't listened to? Like has a new one come out for like November or something like that?
It was October 20th. It came out.
Okay. So probably, right? Because last one he was talking about kind of like John seems to talk a lot about, he's kind of talking to builders, not so much real estate investors, right? So there is a certain amount of context that you got to layer, at least my experience with listening to these calls, there is context to layer in from looking at it from a builder standpoint to looking at it from this asset class standpoint. So I'm looking forward to hearing your interpretation.
Yeah. Well, you know, John, I mean, this whole space has been evolving, you know, the build to rent space and the aggregator, which is what you would call us, you know, we are I guess we're a large operator now based on the number of homes we own. They define it as 1,000 homes that you own or more. You'd be a large operator. So, but we're really kind of like that medium to large operator. Like most of the large operators are like American Homes for Rent, you know, Invitation Homes, right? Tens of thousands of homes. We don't have that. But what we are seeing is that there is this space now for build to rent and for builders and aggregators like us, along with some of the big guys, to be buying and holding assets. So what we've seen over the years for John's messages, he's created a space now to talk to us, whereas in the past it was largely builders or other folks. So it's pretty cool that just another sign that this asset class is here to stay from an institutional perspective. And so there's a lot of good stuff that is in those calls. That's the basis of a lot of the information I bring to you guys as well. So I think it's a pretty cool source.
We got a first-time community member here who came in from the text. So
welcome.
Chiming in as not your average guest. Would love to know your name if you want to let us know in the chat. But our guest writes, great show. My first time here. Love to have you. Hope you make it a habit. And how many of your investors eventually sell their property? At what time point from purchase time? And for how much more on average?
Love that question. Thank you so much for being here. You know, it's really important to talk about the expectations we set when clients come on board. And, you know, if you jump on a phone call with my team, at some point, we're going to talk to you about your horizon. And we are very, very open that the best way to win in rental property investing is to invest for a full market cycle. So that would be between 10 to 20 years. So the vast majority of clients that come on board are holding for a long time. Now, of course, life can happen and have other clients sold in less than 10 to 20 years. Yeah, of course they have, but that's the expectation. That's how you win. So people are expecting to hold for a long period of time. I think your other question is how much do they sell it more for on average?
Yeah, like what percentage sells and how much money do they make essentially?
Well, there's a couple stats that I love to share with all of you, right? Number one is that 100% of JWB clients are beating their return expectations. That is over 2,800 properties that have been purchased by clients just like you out there. 100%, all of you are beating your return expectations, right? That's because we have 5 profit centers that work in your favor. Okay, so that's since 2011 too. That's not just like a last year thing. So
it's because you guys have 5 profit centers that work in our favor, and because you always under promise and over deliver, and it's a core value, right? Yes. So like you were just telling me this last, behind the scenes here last week, of this idea of like, man, we've been beating expectations by 100%. I wonder if we can set slightly higher expectations and still beat it by 100%, which is not the normal thing in this industry, right? Most of the time, they're putting like a performer with in front of you that's just like, this is going to be amazing. And then they get 85% of that and the experience is way worse. Whereas you do the opposite.
Yeah. So what that means, let's relate it to this property on Glen Gardner. Like that number, 11.4%, we memorialize that for the client who purchased this. And we report on that every single month. And 100% of you out there, we are beating that. Like, what are the chances you're going to be the one client who we underperform for?
Yeah.
Right. Like that's what gives me so much, just literally just trying to help people. So, clearly I have an incentive to sell properties. You all get that. But like, I think about the choices that people can make going into what we know is coming in this future year. And the fact that I know we have performed for 100% of our clients. And I just think, wow, we can really, really do some good things for clients out there. On the home price appreciation perspective as well, there's a reason that our clients perform better than the average Jacksonville investor. It's because we're vertically integrated. It's because everything is under one roof. It's because we are active in the social, the economic, the political arena here in Jacksonville. We are doing things to solve problems that are not just showing up as far as, how do I make sure I collect your rent today? It's how are we raising median incomes in downtown Jacksonville so that the rents and the home prices surrounding downtown Jacksonville, which is where this home is and where all of our properties are, can continue to go up in value over the coming market cycle for you. And that's because my money's there too, right? So we're doing all this. All this comes down to say that our investors, JWB clients, have earned 79% more home price appreciation than the average Jacksonville investor since 2013. So you combine both of those things. 100% of our clients are beating their return expectations. And as a part of that, our clients have earned 79% more home price appreciation. Like, guys, that's why I'm speaking from my heart and telling you you should call us. You really should. It's especially knowing what is going on in other asset classes right now.
So that's Zlatko, who is new to the show. He lives in Jacksonville. Zlatko, happy to have you. Hope you come back and hang out with us and be a member of the community here. GC, when you say 79%, we're beating expectations by 79% of the rest, you're saying you're beating expectations from what you offer on a property sheet, 100% for anybody that's owned the house over a year. Right?
Yes, that is.
And you're beating the market by 70. You're beating other investors by 79%. Is that, what do you mean by that? Do you have like data on other investors that liquidate, or is this just like against the average home price appreciation?
I'm glad you asked about that. So when I'm talking about 79%, that is that JWB clients have earned 79% more home price appreciation than the average Jacksonville investor. And so I look at our 4 core neighborhoods where our investors invest, and I run the appreciation rates just on our 4 core neighborhoods. And then I compare that to what the average Jacksonville appreciation rate is in 2013. And so you compare those two things, our investors are earning 79% more home price appreciation than the average investor. And the average Jacksonville investor has earned a lot more home price appreciation than your other cash flow markets out there.
It's a good deal.
It's a good deal. I don't know what to tell you. It's a good deal.
It's a good deal. All right, GC, this is a great POT dubs, man. I feel like an hour just flashed like that. But we never take it for granted that we had like 37 people on at one point, just hanging out with us here, middle of a Thursday, middle of your work week, that made it fly by, right? Like, and asking great questions, and like Kelly and Zlatko, and inserting great context, like Drew and Bob and everybody and Darlene that add to the conversation, making this thing fun, making this easy, making it valuable. Just really thank you from the bottom of our hearts for making this such an awesome use of our time. And again, my team, we produce the show and we have this big editing capability, and my team has this like tradition where we make compilation birthday videos for us. And the idea that like 5 folks of you, 5 of you from the show, Jen, Hervé, Marilyn, Drew, and Lee, all contributed to my birthday celebration. And of course, GC was like singing Total Eclipse of the Heart on that.
I had the spirit fingers going.
The spirit fingers going. This community means the world to me. So I just thank you so much for making me feel special and allowing me to do this thing. Thank you for being a part of this. And GC, I'll give you some final words before I tease next week.
Well, we love you guys. And it really matters to Pablo and I. So thank you for being here. We will not have a show without you. It means a lot to us that you guys are here each and every Tuesday and Thursday. I saw some of the comments when I said, hey, maybe I'm a weirdo. And I saw 3 or 4 of you said, hey, listen, we're all weirdos here. And we'll change the terminology to not your average investors, because I think that plays a little bit better. But
the Weirdo Investor Show.
The Weirdo Investor Show doesn't really play as well. A couple of last second questions here from Jag. Are lower price properties available? Absolutely. This is not the only property that is available. So Jag, reach out to the team. We have other properties that do have a lower purchase price for sure. And then Kai asked, please explain the leasing term. The house has rent contract in place already at the time of purchase. Kai, yes, we only sign 2 and 3 year leases. This one is still under construction. So the way that this is built is that we are actively leasing the home on or about when construction is completed, which means that we're marketing the home, hoping to have a resident in place. The vast majority of clients close on the home with a resident either in place at the time of closing or a deposit on the home so that they move in soon thereafter. So that's the expectation I would set for you. Cash flow positive on day one, or very, very soon thereafter is kind of how it goes for our properties.
Love it. I got a couple more birthday wishes. I love you all. On Tuesday, we've got Keith Weinhold, host of the Get Rich Education podcast, a top 0.5% like that podcast makes us look like a baby with their audience and what he does. Keith is one of the foremost investors and educators in real estate out there. So hope you join us on Tuesday. It's going to be an awesome show. And from here till then, if you want to outperform this crazy market right now, you just can't think like an average investor. See you next week.
See you.